How to cover loss in the share market. Welcome to today's video. If you've ever experienced losses in the share market, you're not alone. Every investor, no matter how experienced, has faced setbacks at some point. But here's the good news. Losses are not the end of the story. They're just a stepping stone in your journey to financial success. In this video, we'll explore practical strategies and tools to recover from share market losses, rebuild your confidence, and move forward smarter and stronger. Let's dive in. First, let's set the record straight. Market losses are a natural part of investing. The stock market is highly dynamic, driven by factors like market trends, unexpected global events, and economic changes. As a novice investor, it's important to understand that not every investment will yield positive returns. Why do losses happen? They might stem from impulsive decisions made in the heat of the moment, lack of proper research, or even external factors beyond your control. Remember, losses don't define you as an investor. How you respond to them does. Stay with me because by the end of this video, you'll have a roadmap to confidently tackle these challenges. One of the most important lessons in investing is to reframe losses as opportunities. Every loss teaches us something valuable. Instead of seeing red numbers as failures, look at them as tuition fees for the lessons they've taught you. By adopting a growth mindset, you can transform anxiety into empowerment. The goal here isn't to avoid losses altogether. That's impossible. The goal is to learn from your mistakes, refine your strategies, and come back stronger. Whenever you face a setback in the share market, it's wise to take a step back and reassess your goals. Ask yourself, what am I investing for? Is it to build wealth for the long term, fund retirement, or purchase a big-ticket item in the future? Knowing your why gives clarity and puts temporary losses in perspective. For example, if you're investing for long-term wealth creation, a short-term dip doesn't matter much. But if your goals are unclear, losses can feel overwhelming. So, redefine your investment objectives and ensure your strategies align with what you truly want to achieve. One of the golden rules of investing is diversification. Never place all your eggs in one basket. If one stock or sector faces challenges, a diversified portfolio can act as a buffer, minimizing your overall losses. For beginners, this might mean investing across various sectors, such as technology, healthcare, and energy. You can also explore different asset classes like mutual funds, ETFs, or even bonds. Diversification reduces risks and creates a balanced safety net for your investments. A stop-loss order can be your best friend in unpredictable market conditions. It is a tool that automatically sells your shares when their price drops to a preset level, limiting the potential loss. For example, if you buy a stock at $100 and set a stop-loss at $90, your shares will automatically sell if the stock falls to $90. This protects your capital and helps you avoid the stress that comes with sudden drops. Stop-loss orders ensure you minimize risk without having to constantly monitor the market. Now let's talk about dollar-cost averaging, a simple yet effective strategy to recover from market losses. It involves investing a fixed amount of money at regular intervals, regardless of the market's ups and downs. Why does this work? When prices drop, you purchase more shares. When prices rise, you purchase fewer. Over time, this smoothens out the cost of your investments. This strategy gives you the discipline to keep investing consistently, even when the market is rocky. Investing isn't a one-size-fits-all game. Some people are comfortable with high levels of risk, while others feel more secure with safer investments. Understanding your risk tolerance is crucial after experiencing losses. If you find that your losses are causing anxiety or sleepless nights, it might be time to adjust your portfolio. Perhaps you need a mix of high-risk growth stocks and lower-risk conservative investments to balance things out. Knowing your personal limits helps you create a portfolio that's sustainable and stress-free. Achieving a balanced portfolio means carefully mixing higher-risk investments with stable, reliable ones. While it's tempting to only chase high yields, it's important to balance these with safer options like bonds, index funds, or dividend-paying stocks. For example, you might allocate 60% of your portfolio to growth stocks and 40% to safer income-generating assets. This way, you'll protect your portfolio during market downturns while still leaving room for growth. One major reason for investor losses is lack of preparation. Relying on hot tips or gut feelings is risky. Instead, commit to thorough research before making any decisions. When researching a company, consider factors like its financial health, profitability, growth potential, and competitive advantages. If fundamental analysis feels overwhelming, There are user-friendly tools like investment apps and summary guides to help you make well-informed decisions. Emotions are your biggest enemy in the share market. Fear and greed can lead to irrational decisions, like panic selling during a downturn or buying overpriced stocks during a hype phase. The key is to keep emotions in check and stick to your strategy. For example, if an investment was sound when you purchased it, temporary market drops shouldn't shake your confidence. Discipline and consistency are far more powerful than chasing market trends. If you're feeling overwhelmed, don't hesitate to seek professional guidance. A certified financial advisor can help you create a recovery plan tailored to your specific situation. They'll analyze your portfolio, provide insights into market trends, and suggest adjustments to minimize future risks. Seeking help not only saves time but also gives you confidence in the strategies you adopt moving forward. One of the best defenses against losses is continuous education. The more you learn, the better equipped you'll be to navigate the complexities of investing. Read books, attend webinars, or take free online courses on investing basics. Stay updated on market news and trends. When you commit to lifelong learning, you develop the confidence and skills to make smarter decisions. Performing regular portfolio checkups is essential for staying on track. Review your investments at least quarterly to understand what's working and what's not. Look for trends. Are certain sectors consistently losing value? Has a particular stock underperformed? By maintaining proper records, you'll notice patterns over time and adjust your strategy accordingly. Every loss contains a lesson. Reflect on what went wrong. Did you invest in a company without fully understanding its financials? Did emotions cloud your judgment? Once you identify the root causes, commit to avoiding the same mistakes in the future. Remember, no investor is perfect, but great investors constantly refine their methods. The stock market rewards patience. It's tempting to react quickly during downturns, but sometimes the best course of action is to hold steady. Markets are cyclical. They dip, they recover, and they grow over time. For example, if you invested in a strong company with solid fundamentals, trust its ability to rebound after a temporary setback. Patience is not just a virtue, it's a skill you must develop to succeed as an investor. When markets are turbulent, focus on the fundamentals. Invest in companies with strong balance sheets, consistent profits, and a competitive advantage. These businesses tend to recover faster during challenging times. By focusing on the basics, you can avoid falling into the trap of chasing speculative or overly risky investments. Here's a big misconception to clear up. You don't need to perfectly time your investments. In fact, even experts fail to consistently predict the market. Instead, focus on time in the market. Long-term holding has historically outperformed short-term trading. By staying consistent and avoiding the stress of timing, you empower your portfolio for sustainable growth. Market losses become far more stressful when you dip into money you can't afford to lose. Always keep an emergency fund separate from your investment accounts. Ideally, this fund should cover 3 to 6 months of living expenses. Having this safety net ensures that you aren't forced to sell assets at a loss during a downturn. Overtrading is a common mistake among novice investors. Making frequent trades in hopes of quick gains can lead to unnecessary losses due to transaction fees and poor timing. Instead, focus on building a long-term portfolio. Stick to your strategy, trust the process, and avoid the temptation to overanalyze every market move. There's a reason seasoned investors emphasize the importance of holding long-term. Compounding, the process of earning returns on reinvested earnings, becomes exponentially powerful over time. A downturn today won't matter much 10 years from now if you stay consistent and patient. The longer your investments stay in the market, the greater their potential to grow. As we wrap this up, let me remind you, every investor faces losses, but not every loss is a failure. It's how you respond that determines your ultimate success. Each challenge is an opportunity to learn, grow, and become a smarter, more resilient investor. Stay focused on your goals, trust your strategies, and believe in your ability to recover and thrive. You've got this. Thank you for watching, and remember to like, comment, and subscribe for more educational content on investing. Share your own experiences in the comments below. We're all in this journey together. Let's grow smarter and stronger, step by step.